Hey guys, welcome back to my financial focus. In this video, I'm going to be doing part 2 of my balance sheet review or my balance sheet breakdown and explanation, just going through the balance sheet step by step with each individual line item so that we can break it down and better understand what it is that we're actually looking at. So in the first part of this balance sheet series, I talked about the assets on the balance sheet as well as the structure of the balance sheet. And so now I'm going to move on to the liabilities section of the balance sheet. And so first off, we see the first line item, liabilities. And in financial accounting, a liability is basically just defined as something that has some sort of future sacrifice of economic benefits that the entity, in this case Tesla, is obliged to pay or sacrifice in the future as a result of some past transaction or past event that the company went through. And underneath that, we see current liabilities. And this is similar to current assets in the assets section, where it basically just applies to all of the liabilities that are expected to be settled in cash within the fiscal year or the operating cycle of a given firm, whichever period is longer. And as I touched on a little bit in the last video, some companies report operating cycles that are longer than 12 months. They could be 18 months. So in that case, the current assets and current liabilities sections would include liabilities and assets that are expected to be settled in cash within the next 18 months, not just the next 12 months. But 90 to 95% or even more of the companies that create annual reports and report their financial position and things like that, they have operating cycles that are typically around 12 months, as we can see right here, December 31st, 2019 to December 31st, 2020. It's just 12 months. And that's how it is for like 90% of companies that report their financial earnings. So in this case, for current liabilities, all of these liabilities are basically just listed under current liabilities because they're expected to be settled in cash by December 31st, 2021. And so right underneath that, we see our first current liability, which is accounts payable. And remember that whenever we're looking at a balance sheet, the liabilities that are listed at the top of this liabilities section are the liabilities that are most liquid. So these are the liabilities that are easiest to convert into cash. And then as we get lower and lower down the liabilities list, we get to the liabilities that are not as easily converted into cash. And that was very similar to the assets section, where at the top it shows the assets that are most easily liquidable or turned into cash, or in this case it's already cash. And then as we get lower, it becomes harder to convert those assets into cash. So it's the same thing in the liabilities section. And so with accounts payable, what that essentially is it's when a business owes money to their suppliers. So it's basically the exact opposite of accounts receivable. As I touched on in the first video, accounts receivable is when a business is owed money from their customers. And so if we were to look at their customer's balance sheet, for example, then all of the accounts receivables that Tesla is owed by a customer, that would be recorded as the customer's accounts payable, if that makes sense. So in this particular case, let's say Tesla is buying, I don't know, raw materials or lithium from another supplier or something like that. Then on their supplier's balance sheet, the amount of lithium or raw materials that Tesla bought from them on credit, that would be listed on their balance sheet as accounts receivable. But since Tesla was the one buying, not selling in this case, it's listed on Tesla's balance sheet as accounts payable because they owe the suppliers money, not the other way around. And then right underneath that, we see accrued liabilities. And accrued liabilities is basically accounts payable, but it just hasn't been billed to the company yet as of December 31st, 2020. And they had to record it in a line item in order to be as transparent as possible in their financial reporting. And so they end up recording it in this accrued liabilities section. It's basically just money that the company knows that they do owe to suppliers, but the suppliers have not billed them for the services or the goods that they sold to them yet. And so they get recorded in this accrued liabilities and other section. Then right underneath that, we see deferred revenue. And this is pretty interesting. It's kind of similar to prepaid expenses in the asset section where some people watching might be confused as to why revenue is considered to be a liability. But the reason why it is because it's deferred, and sometimes it's also called deferred income. And in accrual accounting, we're recording revenues and expenses when we earn them. So not necessarily when the cash is received or when the cash leaves the business. We're recording revenues and expenses when we earn them. And so in the case of deferred revenue, Tesla in this case has actually received cash or payments for cars or something else from customers before they've actually delivered that car or that service to that customer. And so if they don't deliver that service or that good to the customer in the future, then they would of course have to give this revenue back to that customer. And so that's why it's considered to be a liability, because it's something that is going to be a future economic sacrifice. They're going to be giving up something in the future in order to have this revenue get actually listed on their income statement. And so that's why it's called a liability, because it's deferred revenue, so they haven't earned it yet. And so that's an obligation that they have to an outside party in the future. Then right underneath that, we see customer deposits. And this is pretty similar to deferred revenue, but there are some small differences in that although it's similar, where a customer deposit is basically cash paid to a company by a customer, which the company hasn't yet provided the goods or the services for in exchange. It can also be a deposit for some sort of delivery of a good or service, and it can be used as collateral. So like almost like a down payment or a portion of the money that's owed for a specific service. And so that would get recorded in Tesla's case right here in customer deposits. Then right underneath that, we see current portion of debt and finance leases. And debt and finance leases, these are basically just obligations that Tesla has to outside parties, just maybe banks or other outside entities that they owe money to. And the actual debt and the finance lease contract might be longer than 12 months or longer than the operating cycle of a company. It might be 30 years or 40 years or something like that. But the current liabilities takes into account all of the liabilities that are going to be converted into cash in the next operating cycle. And so in this case, the current portion of debt finance leases is basically referring to the principal and interest payments that are due for Tesla within the next 12 months, but that belong to a debt or finance lease that is greater than 12 months total. So for example, if they took out a loan from a bank and they're expected to pay back the full principal and interest over a 30-year period, they're obviously going to be making payments month to month or annually. And so this current portion of debt and finance leases is basically just taking into consideration the payments that are owed within the next operating cycle for this long-term debt and finance lease. Then right underneath that, we see total current liabilities, and this is just all of these current liabilities added up together, and that gives us this total current liabilities line item right here. And then right underneath that, we see debt and finance leases net of current portion. And so as I just said, the debt and finance leases, they can be as long as 30 to 40 years. And so this debt and finance lease line item is taking into account the entire debt contract or the entire finance lease. So over the entire 30 to 40 year period, it's taking into consideration all of the principal that they borrowed, for example. And they're subtracting, in this case, the current portion of debt and finance leases because that already got recorded in the current liability section. That's why it says net of current portion, because it's basically just taking the total debt and finance leases minus the current portion of debt and finance leases to give them the debt and finance leases net of current portion. Then right underneath that, we see deferred revenue net of current portion. And this is very similar to the line item right above it. Deferred revenue, this account is usually classified as a current liability on most balance sheets. And that's because deferred revenue is usually going to be some sort of obligation or performance that's expected to happen within the next 12 months. But in some cases, the actual performance might be classified as a long-term liability because it's not expected to be performed within the next 12 months. And so in that case, we get deferred revenue net of current portion because they're basically just taking all of the performance obligations that they have to customers in the future past 12 months. And they're subtracting the deferred revenue, which is the performance obligations they have to customers within the next 12 months. And that gives them deferred revenue net of current portion. Then right here we have other long-term liabilities. And this is just taking into consideration all of the other debts that are due beyond 1 year that weren't really deemed significant enough to warrant their individual identification on the company's balance sheet, the same way these different individual line items got for themselves. And so they were all just summed up and included in this other long-term liability section right here. And then after we add these three line items together, we get along with the current liabilities, we get the total liabilities down here. This just takes into consideration all of the current liabilities that Tesla, in this case, is expected to meet, all of the obligations they're expected to meet within the next 12 months, plus all of the obligations that they're expected to meet, period, in the future, past the 12 months. And that gives them the total liabilities line item right here, which comes out to be about $28 billion. So quite a few total liabilities. And that basically wraps up everything to do with the liability section for the balance sheet. In the third part, I'm going to be covering these three line items right here between liabilities and equity, and then I'm going to be finishing off the balance sheet by going into detail with equity. A lot of this stuff can be kind of confusing to some first-time readers of the balance sheet, so I'm just going to break it down and try to make it as simple as possible. Leave a like on the video, subscribe to the channel, and I'll see everyone in the next one.